but cash flow focus can be much more stable and predictable than trying to predict equity or what stock's going to go up and double or things like that. No one really has those answers.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name is Randy Smith, and I'll be your host today. And we have an amazing guest for us today, Travis Watts. Travis is the Director of Investor Educations for Ashcroft Capital. He's invested in over 50 LP positions, and he is a guy that I have been following for years in this space. So super excited to have you on the show, Travis. Welcome.
Thanks so much, Randy. Good to catch up again.
Awesome. Well, hey, why don't we just go ahead and jump right in? Can you tell the listeners a little bit about yourself and kind of your journey to the passive investing space?
Sure, we'll dive into that. I'll kind of give you an alternative story. I don't usually come from this point of view, but basically, if there is a claim to fame, I would put it this way, and that's that in my early 20s, I started getting into real estate. Always had the idea or the ambition to build up passive income streams that I could end up living on long term. So the way I went about that is the way a lot of people approach real estate investing when they're new, and that's buying single family homes and renting them out. So I did all kinds of little strategies for about 6.5 years, from having roommates, which is now called house hacking, apparently, fix and flips, vacation rentals, buy and holds, that kind of stuff, doing it all myself, thinking naively that I'm going to scale this thing up to having, 100 single family homes and I'm just going to pull the plug and retire. But I didn't realize that, first of all, my W-2 job was like 98 hours per week. So that was quite a load in itself. And then trying to scale this was so active, even though I had property managers helping me and, lots of help from lots of angles, but it still was a lot of active involvement. I still had to show up to closings. I still had to do underwritings. I still had to submit offers. There was a lot involved. And so not even 20% of the way to that goal of having 100 properties. And I burned out basically. And so that's at the point that I said, okay, I got to get real with myself. I don't know what I don't know. Perhaps I should look for some mentors or other people who are highly successful in this real estate space and see what they're up to. So I joined a pretty large real estate meetup group out in Boulder, Colorado. And the facilitator and his partner had sold their companies in the mid 1990s. And they had become kind of overnight investors. They never anticipated a windfall like what they had from that sale. And so they had to go put that capital somewhere. And it turns out that a primary place that they parked their capital was in something called real estate private placements or syndications. And this was foreign language to me. I had no idea what that meant. And I had no idea that you could actually partner in large commercial real estate, like a 400 unit apartment building with as little as 25K to 50K sometimes. And that's exactly what these guys were doing. So they had probably, if I had to guess, over 100 limited partnership positions in various projects across the nation. And the beauty was it was a hands-off approach where I could get all the same benefits that I was getting doing it all myself. Right? So they could still use leverage and debt, still get tax advantages, still get monthly distributions, still have equity upside, but they didn't have to be a landlord. And that's what was killing me, is being a landlord. So with that, had my W-2 job, saved as much money as I could save, was putting all of that toward passive income producing assets, much of which was real estate. And in 2015 and 16, decided to sell off my single family homes and really take that strategy serious, since they had opened up to me freely as mentors to, help me learn that path. And so I've been on that path ever since. It's been, 7, 8 years. I'm bad at math, but anyway, just been a full-time LP ever since. And a few years ago, joined up with Joe Fairless and Ashcroft Capital to leverage my outreach, to help share with people how you can build diversified income streams that you can use to enhance your lifestyle or switch to part-time work instead of full-time work, or maybe retire. It's a beautiful thing. I was able to help my dad, who worked at the post office over 30 years of his career, retire primarily off of real estate and primarily off of syndications, because he was looking through the lens of the traditional Wall Street world, saying, okay, I did all the right things I was told to do, my 401k, my IRA, et cetera.
Mhm.
How do I now convert this nest egg into passive income? And at the time when he retired, he's looking around saying, well, bonds are 2% yield and the bank's not paying me anything, and annuities are 3%. How am I supposed to retire on passive income? And so
Yeah.
it can really lead to something called time freedom. That's a term I like to use. And for him, it was about he wanted time away from work. He wanted retirement. He wanted time with me, my sisters, family. And so the bigger picture here is not about dollars and cents. It's
Mhm.
about freeing up your time. And you can do that through private placements. And that's primarily why I chose that as my primary niche. So that's kind of the story
Awesome.
in a nutshell.
Yeah, so there's ton to unpack there, and it's a similar journey we hear time and time and time again about people know that real estate is most likely a path to this time freedom that we're all searching for, and financial freedom as well. Um, and the easiest thing it seems like to jump into is that single family space. I did the same thing. I've interviewed dozens of other people that have done exactly that. So um, I know part of your journey is helping to educate folks on passive investing initially. Do you think it actually is a good path to go down the single family space, or is it better to just jump right into passive investing initially? I certainly have my own opinions, but I'd love to hear your thoughts.
It's a great question. I've been asked this a lot. If you could rewind
Sure.
back to your first deal, Travis, would you have been a passive investor? The answer is yes and no. Yes, in the
Mhm.
sense that I would have done some kind of investment that yielded some passive income. However, I was more equity focused in the beginning because I needed to build up more of a nest egg in order to have
Yeah.
enough capital to generate meaningful passive income. So I always like to think of it like this: if you had, $1 million to invest, and you found
Mhm.
something yielding 10% a year, that's 100 grand. So it all of a sudden starts to be a little bit life changing. 100 grand can help a lot of people in a lot of ways. But if you're talking about having $500 to your name and that's what you have to invest, would you go do something at a 10% yield? It's just not going to be life changing, right? So I
Yeah.
think there's a lot of benefits to learning the foundation of real estate if that's what you want to do, if that's your interest, if you think maybe I want to be a house flipper, maybe I want to be a general partner in a syndication, maybe I want to be the person because I'm a handyman or handy woman, or
Mhm.
I have a background in this, or I come from a family of do it yourself. I mean, there's a lot of reasons why people are active in the space, but I learned the hard way, going through the motions the wrong way, not knowing
Mhm.
how to
Mhm.
screen tenants, not knowing how to do handyman work, not knowing how to build teams, not understanding the tax code. So I just made a lot of mistakes. And for me, it just became a headache and a hassle. And so I wasn't enjoying the active business of being in real estate. What I was enjoying is building passive income streams that just kept compounding to the point that I
Yeah.
could say, hey, I don't want to work in oil and gas anymore. I want to go focus on something I actually enjoy and want to learn. So I went to go work for a large brokerage firm, one of the largest in the world, and I got licensed Series 763. I wanted to learn stocks, bonds, and mutual funds because investing was the core and the heart of what my passion is. Now, turns out that wasn't really the right path for me, and that's okay. But I had the
Mhm.
backstop of having passive income every month to where I didn't need that job. I wasn't doing a job for the income, I was doing it for the experience. And I think
Mhm.
that's a very rewarding place to put yourself in or to build up to, is where you can take a sabbatical. You can take 6 months off of work. You can, like I said earlier, transition to part-time work. You can go
Yeah.
pursue what it is you're really interested in. So with all of that in mind, I like to tell this to the audience too. my nephews have kind of been watching my progress, right? Their ages are
Hmm.
between 21 and 16 right now. And I opened some brokerage accounts for them. And what we invest in are publicly traded REITs, real estate investment
Hmm.
trusts, because the barrier of entry is so low. I can give them $100 in their brokerage for their birthday or something. They can go buy 10 shares of some REIT, and then they can start seeing that they're getting paid every single month, and they can
Yeah.
start scaling that. And so every year, for holidays, one-off occasions, Christmas, whatever, I give them money for their brokerage account. And so I'm teaching them the foundation, right? And so hopefully when they go get into their careers, they can start dumping thousands of dollars there, and hopefully they can eventually become accredited investors, and they can get into these larger deals and scale that up. So the point is, somebody could start their passive journey with as little as $10. Free brokerage account, $10, free trades, one share. There you go.
Yeah.
In the private placement world, you're going to need at least 25,000 probably to get in. And then, it's just a different game and a different level, but it's the same strategy. All I did with my mentors that I found back in 2015 is I just mimicked what they did as a strategy, right? I didn't
Hmm.
have 100 million net worth like they had, or whatever it was. I'm, roughly those numbers, but I was able to mimic the same results by just copying that strategy and subscribing to the philosophy that you invest for passive income, not for potential equity. The whole buy low, sell high is the whole Wall Street model. But as we know,
Right.
in years like this year, that doesn't always pan out.
Right. 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 Very good. Yeah. Thank you for that. It's a much more detailed answer than I've gotten from folks in the past, and I think it's um, it's a neat journey that you talked about, like literally everything from the $10 to $500 investor all the way up to the folks with 100 million net worth. Um, when I look back at my time, I could have probably started with passive investing because I was bringing, I leveraged a HELOC. I was bringing X amount of dollars to the table, call it 50 or 100 grand.
Yeah.
And by doing that, using the BRRRR strategy, ultimately I did create some equity. But at the end of the day, had I just taken 100 grand and put it in 4 different syndications over that 3 or 4 year period, I most likely would have ended up better off than I was even doing the BRRRRs. So yeah, it's an interesting idea that, and I like that strategy of leveraging REITs when you maybe don't have the big dollars to put into it, but at least get you into the mindset of investing in real estate, seeing immediate benefit from those returns because you're
Yeah.
not just sucking it away in a 401k or something like that. So interesting.
Yeah. And I think because it's not mass marketed and talked about, because Wall Street's system is just put your money in here and hopefully things go up over time. And then meanwhile, they collect fees throughout that period of time, right? That's how the system
Yeah.
works. It's not marketed to talk about passive income very much. But I just think it can be so powerful to realize what implications that can have if you don't subscribe to the I'm going to maximize a 401k till I'm 65 and then take a peek at that.
Mm-hmm.
And hopefully it's enough. But you can start enhancing your lifestyle immediately through passive income at any age, even like my nephews, one at
Yeah.
16 years old can start seeing, every month I get $15 paid out to me and I didn't have to work or do anything for that. And I just hope that at some point that really clicks and they say that 15 could become 1500 and that 1500 could become 15,000. I just have to scale this model. And it's much
Yeah.
easier to scale a passive model than it is an active model by telling them, go, buy one rental property a year until the day you die or something like that. Trust me,
Yeah.
that's hard.
Well, and I think it's a good point too, in that I think a lot of people get into real estate because they want the get rich quick scheme.
Yeah.
But this is a get rich slowly over time.
Yeah.
And I think kind of the perfect marriage is really trying to find an area where you can make good dollars as a W-2 income earner or a 1099, whatever that is, but you have to have the ability to generate income,
Yeah.
so then you can partner that with your passive investing strategy. And I know you've had different strategies over the years doing that, but do you have any advice maybe for the
Sure.
new real estate investor that might want to go down that path?
Well, I'll tell you what I did. And I did 4 steps. Okay. And it was that number one, I earned as much as I could earn using my highest and best earning potential. And coincidentally, it's not what I went to college for. I completely
Hmm.
180'd from my degree. And I went into oil and gas because I could work 98 hours a week and get a ton of overtime and get bonuses and get per diems and get all this kind of stuff.
Yeah.
So I ended up hustling basically and then
Yeah.
doing active real estate on the side of that for even more income. So for me, that was
Yeah.
my highest and best. Now, I don't advocate people do exactly that, of course. You just have to look at how much could you make and what extra things could you do for supplemental income on the side. Number two, I lived on as little as possible for a period of time. So I'm not one of those advocates of, use coupons till the day you die and buy the off brand and blah, blah, blah. Just take a
Hmm.
period of time and put a little sacrifice in. Okay. So I was living like I was a
Hmm.
college student still throughout most of my 20s, even though I had way more means to do a lot of different things with that money.
Hmm.
Number three, I invested in things that produced passive income. And a lot of people don't realize how many options exist between ATM machines and self storage and mobile home parks and car washes and multifamily and single family duplexes, house hacking, anything, man, getting a vending machine and having someone manage it. And then it's a cash flow
Right.
to you. There's so many things you could do. The publicly traded REITs for $10 a share on some of those. So that's what I dumped my money into. And over time, it just compounds. When I put 100,000 into a syndication and then 3 to 5 years later, let's just say for example purposes, I double my money. So now I have
Hmm.
200 grand. I sell, I pay a little bit of tax and I diversify. And now I do two deals. So that one source of capital just turned into two streams of income. Now, when those sell, I'll divvy them up and I'll have four streams of income 3 to 5 years
Yeah.
after that. And so it's a snowball. We all start with one deal, one investment. It's always scary in the beginning, but it does compound. And so, you know, Warren Buffett has a quote, something to the effect of never rely on one income source, create investments to
Hmm.
create a second source, basically. And I say create multiple sources. I probably have
Hmm.
50 plus different streams of income. So it gives you so much more peace of mind and security that, things happen in this world, whether it's getting laid off of your job, whether it's a divorce or whether it's a medical expense, but to have a backstop throughout your lifetime that helps supplement your lifestyle can be extremely meaningful and could really avoid a lot of problems that people have financially. So it's just thinking differently, right? It's not the whole
Hmm.
buy low, sell high, and stock it away under the mattress till I'm 70 years old and hope it works out.
Okay, so let me review if I can. With the four steps I have, or actually, I just had three, so I want to confirm the fourth, but I have basically make as much money as you can in whatever capacity that is. Number
Yep.
two, live cheap for a period of time or live frugally. Three, invest passively. And then four
Yeah,
was
sorry, I left off number four. Avoid bad debt. So, what I mean by bad
got it.
debt, this is the way I define bad debt. If you're paying interest on debt that's higher than what you could otherwise achieve through an investment potentially, to me, that's bad debt. So, we'll use the example
Yeah.
of a credit card. You got 10 grand on it, you're paying 20% interest, and you think, well, if I invest, I could get 10% interest. Well, pay
Mhm.
off the debt, right? Because it's 20%. Now, if we're talking about low interest, say you have student loans or something at 3%, well, you might consider otherwise investing at maybe 10%, using some of that cash flow to help pay down that debt if that's what you want to do, or just not pay down that debt. I mean, just make your payments. I mean, it's
Sure.
up to you. I'm not giving anybody financial advice. I'm just saying that's how I think of it. So my parents taught me at an early age, never, never, never keep up with the Joneses. There's always someone above you. There's always going to be
Yeah.
the newer and better car and the bigger house and the more toys,
Yeah.
but it's a trap. And you're going to end up
Yeah.
trying to impress people that don't care about you. You're going to end up broke and you're probably going to lose everything anyway in the process. So I
Yeah.
don't subscribe to that. Anything I buy is for my own personal pleasure. And it's not about, impressing other people. So number four, avoid bad debt.
I love it. I love it. And never keep up with the Joneses. We could just say that and say thank you, and that would be a very beneficial podcast. But um, Well, very good. Now I know you've been talking in this space, you've been educating for a lot of years in this space. You've got a number of different strategies and techniques that you share. You mentioned an 8% rule or an 8% strategy. Can you walk
Yeah.
the listeners through that as well?
Sure. In 2015, this is the first time when I was learning about these syndications and really was getting professional, let's say, to an extent over passive income. And I said, okay, if I liquidate everything, this was my thought process. If I sell all my single family homes, my rentals, even the house I was living in, if I just went liquid, I paid the realtor commissions, I paid the taxes, what would my net worth be? What would I actually have in the bank? Then, what if I took that net worth and then I started diversifying into these private placements, 50K here, 50K there, 100K there, 25K there? Then
Yeah.
what yield annualized could I reasonably expect? Now, obviously, the market was a lot different in 2015. To me, a very conservative cash flow at that time was 8%. And so I just reverse engineered the math and I said, okay, 1.25 million, 8% a year, $100,000. That can allow me to leave oil and gas. And again, 1 million at 10%, same outcome, right? At
Yeah.
4%, if you want to be conservative and go invest in bonds or something,
Hmm.
2.5 million at 4% is 100K. So
Hmm.
you can run your own numbers, you can run your own percentages and figure this stuff out. But I decided to dedicate to that philosophy and I still use it today because a lot of people, what I hear is, well, you can't just get in a syndication today and get 8% cash flow. Well, that's true,
Yeah.
but two things. One, I have deals in my portfolio that have been in there for years and years that are cash
Yeah.
flowing at 12, 13, 14, even 15% annualized. So if I get in
Hmm.
a new deal today at 6% or even 5%, I'm still averaging the 8, right? And the
Yeah.
other thing is that aside from syndications, there's things you can invest in with more yield. For example, I do note lending sometimes or hard money lending, and you can get,
Hmm.
let's say, 10% there. So again, I do a 6% here, I do a 10% here, and I'm still kind of meeting my average goal of living on 8% cash flow. So I'm
Hmm.
still able to maintain that. It's not a suggestion for anybody else. It's just something that I target in my own portfolio. And we're not even talking about equity upside potential. When these syndications
Right.
sell, there's usually equity there if you're doing like a value add business plan or something. Historically, that's always been there, thankfully, in my investments, but I don't
Hmm.
bank on it. When I'm looking at projections, I don't say, oh, this one's going to be a 20% IRR. I can't wait for that equity on the back end because nobody
Yeah.
knows if it's going to be there or not. It's speculation. But cash flow focus can be much more stable and predictable than trying to predict equity or what stock's going to go up and double or things like
Yeah.
that. No one really has those answers.
Yeah, so the old rule of thumb, the 4% rule that Wall Street and the stock market,
Yeah.
those folks all talk about is and even that might not be achievable in those markets. So to move over to real estate and feel comfortable with 8%, that's, I mean, it's twice as effective as what you could be getting in the stock market,
Not
right?
only that, Randy, but the traditional, let's define that for anyone that may not be familiar. So Wall Street
Yep.
traditionally says something to this effect. Put your money in your 401ks and IRAs and all these kind of, publicly traded accounts. Okay, cool.
Yes.
Then you have $1 million one day. Awesome. What they're saying is sell off a portion of your portfolio every year at 4% of whatever is in there and live on it. So you'd be living off $40,000 a year on $1 million IRA, let's say. The problem with that is twofold. One, you're selling away your nest egg, right? So you have your
Hmm.
million and now it's going. Now, the theory is that the market is always going up more than that, right? But as we know, in years like this
Yeah.
year, you could be 20 or 30% down, which could be one of the worst times to sell. And you
Yeah.
have to sell. So you're locking in a loss on paper. I mean, not on paper. In reality, you're locking in a
Right.
loss at a timing where you don't want to sell. So living on passive income is preserving your capital. Your 100,000 in that investment, your $1 million out there, that is sheltered and invested and not being touched. It's the passive income coming off of it, right? The
Yeah.
return on capital that you're living on. And that's a huge, huge, huge difference. Not to even dive
Yeah.
into the weeds on tax advantages and everything else and leverage, but yeah.
Yeah.
Anyway,
Well,
big difference.
and I think even in that, using that strategy, some years are going to be well over 4% growth in your portfolio, and I think the standard or traditional investor would have a tendency to want to take out more than the 4%. And
Sure.
then when times are decreasing and it's less than 4%, as you mentioned, it hurts you that much more. So shifting gears a little bit here, as I shared with you earlier, I left my W-2 earlier this year. Up to
Yeah, man.
that point, I was primarily, thank you. It's funny that people in
Awesome.
the real estate space will say congratulations. People in the W-2 will say, oh my gosh, I'm so sorry. Just a different mindset there. Um, but I was a growth investor at that point where I was trying to drive and increase the nest egg and get larger and larger. And very quickly, I shifted over to becoming a cash flow investor.
Yeah.
Um, so I started looking at other types of investments like ATMs
Yeah.
and Bitcoin mining and those types of things. So I'm curious, can you talk maybe to some of the pluses and minuses of some of those higher performing or higher returning asset classes, and maybe some of the downfalls as well, because I believe there are some downfalls or negatives to that as well.
Yeah, exactly. So with something like a syndication, so primarily what I focus on is a value add business plan, which means that we're buying a property, call it a 400 unit apartment building, and it's built in 1999 or 2000. It's 20 years old or whatever. And
Yeah.
the rents on that property are about 200 below market today, and it's because it's outdated. It's because people look at those units and go, ugh,
Mm.
this looks like the year 2000. I don't want to live here. So we come in and we put granite countertops and vinyl plank flooring and stainless appliances, and we pop the colors to whatever's modernized, and we do USB chargers in the outlets and covered car parking and packaged locker systems, added security, LED lighting, Nest thermostats, touch keypad locks. I know I'm going on and on. It's kind of goofy, but we do a
Yeah.
lot to enhance these properties to make them adequate to 2022 and 2023 and what people are looking for. And when we make the amenity spaces better and we put new gym equipment in, and we put cabanas and swings and barbecue pits and all these dog parks and great things around the community, you can justify raising the rents at that point because it's a much better and modernized community. And so that's how we're making money there. Now, the pros and cons are this: you're usually not going to have the highest cash flow on a play like that in the first few years, as you have a lot of turnover and you're doing construction and the rents are already below market and all these things. But hopefully the cash flow starts ticking up year over year as you're able to effectively raise the rents. And then when you go to sell, you have the equity upside potential on the back end. So when you merge those two together and you look at a total annualized return. So at the end of 5 years, let's say when you sell, you look back at those 5 years, you look at all the money you collected from sale and cash flow. It could be, 15 to 20% annualized if you just kind of run the math. So the total return, not including the tax advantages, which are great, can be very strong. But you're having to wait many years for that total outcome. And some of that is speculative, right? On what you're going to sell
Hmm.
for, or if you can sell for a certain amount. The benefit to something like hard money, note lending, ATM machines, things like this, is that you get a higher cash flow today, but you
Hmm.
don't have equity upside on the back end. So it comes down to the investor. What is your primary objective? Are you a retiree saying, I need money now to live on today? I need it.
Hmm.
Well, then those plays might be appropriate for a person like that. But if you're saying, I'm younger, I'm not going to need this money for, 5, 10 years, or, this is just supplemental income I don't need to live on, then a syndication might make a lot of sense. If you're willing to wait for a potential higher return, you can do that. So
Yeah.
there's a lot of different plays that you can do. I do covered call strategies in the stock market. There's even ETFs, exchange traded funds,
Mm-hmm.
that'll sell covered calls every month, and that generates cash flow that gets distributed to investors. So that's a passive way to do that as well. So there's so many ways. I could go on and on about passive income. So I always start with, what are my goals and objectives? What kind of
Yeah.
investment vehicle would be most appropriate to get me there? And if it's all equity, you might consider like a new development project. Usually
Mm-hmm.
the projected end result should be a higher return, but you're taking a little more risk and you're not getting any cash flow throughout the hold period. Or
Yeah.
same example as like flipping a house. It's not cash flow producing in the meantime, but hopefully you get a larger return on the back end. So you got to decide if you're equity focused, cash flow focused, or if you like a hybrid combination of the two, which is what I tend to invest in mostly.
Awesome. Thank you. You are an educator by trade, and you are fantastic at explaining things very simply, which is why I've been listening to you for years. So you do an amazing job. Thank you.
Thanks, Randy.
I would. Can we talk for a moment about Ashcroft Capital? Ashcroft was actually the second investment that I made, and a couple of the reasons I chose them were, one, large, what I considered national brand,
Yeah.
somebody who had a very large presence in the space. Two, it was a fund, so I was a
Hmm.
little more diversified across multiple asset classes.
Yeah.
And three, really, Joe and the team are really just experts in the field. But that was my perspective for choosing Ashcroft. But can you talk a little bit about Ashcroft and what you guys do there as well? I know these are
Sure.
these are 506c offerings. So yeah,
They are.
by all
Yeah.
means.
Yeah. We can, solicit and talk about that, but I won't even get into the deal stuff. What I'll tell you is this. I met Joe pretty early on as well. Like you, I think Ashcroft was maybe a second to third, maybe even a fourth investment that I made in my journey. Met Joe when I lived in Denver. He runs the best ever conference every year, and it used to be exclusively held in Denver. This next year, it'll be in Salt Lake City, Utah. Huge event, thousands of people. He's the author of the Best Ever Apartment Syndication book. Great book if you're looking to go active or passive. And he's the co-founder of Ashcroft Capital. So I had been doing deals as a limited partner with them for years. It was the team, it was the communication, it was the monthly distributions, it was the Sunbelt markets that they were in, it was the value add strategies that they would do, it was their track record. There was a lot of things that attracted me to that model. And when Joe had his firstborn, Quinn, his daughter, a few years ago, I reached out to him and said, "Look, man, my passion is educating people on these syndications. Obviously, you know me, I know you, I'm an investor, blah, blah, blah." I said, "Why don't we partner up somehow? Call me whatever you want to call me. Let me get on stage. Let me get on podcasts. Let me do webinars. Let me write articles. Let me get the word out on such a larger scale than what I can do on my own." And so at first, I was director of investor relations. So I was talking with thousands of investors every year, taking that off of Joe's plate. And then I hired out Evan Pulowski, who's now our manager over investor relations. He's built a whole team under him. It's been fantastic to watch this team grow. But to your point, they used to do one deal at a time until they got too large to do that, where the deals were subscribing in 1 or 2 days. And they moved to a fund model during the pandemic because a lot of investors were on the sidelines and, not knowing what to do, not really investing. So we lowered our minimum down to 25,000. We launched a fund model, which we ran in our own algorithm, was 100,000 times, by the way, on our own portfolio. It ended up being 2.7 times less risky in a fund model compared to doing one deal at a time. So that really resonated well with our investors. And to your point, Randy, you get diversification of different asset types, different sizes of property, different geographic regions between Texas, Florida, Georgia, now North Carolina we've launched into. And so it's a great way if you're looking for all the things that we're talking about, equity upside and monthly cash flow and tax advantages and all that kind of stuff. So they're just a national group, about 2.5 plus billion assets under management. They've taken 26 deals full cycle through the business plan. And we buy about 6 to 10 properties per year, depending on the year, and that becomes an investment opportunity for accredited investors with a 25,000 minimum. So enough about that, but that's kind of the backstory to how I got involved with them. Joe's an amazing guy. And it's been just awesome to watch them expand this team over time.
Fantastic. God, I feel like I have literally a dozen more questions I'd like to ask you, but I think we'll have to save it for another podcast because I like to keep them to about 30 minutes.
Sure.
But I do still have a couple of questions I'd like to go to pretty quickly
Hmm.
for the passive investor who is really trying to get educated and gain their confidence in this space. What are some good podcasts? What are some good books that you might suggest to the listeners?
Yeah. So Joe Fairless owns the brand Best Ever. And so Best Ever Commercial Real Estate now, bestevercre.com. I'm on his podcast. I ran at first a 100-episode series called the Actively Passive Investing Show. And it
Mm-hmm.
was about the active components to being a passive investor. They were kind of longer episodes, 30, 40 minutes. And the feedback I received after doing that for a few years was, we love when you share your strategies, your formulas, when you get right to the point on here's the topic, here's why it's important, here's how you do it. And so I launched a series here a few months ago called Passive Investor Tips. And you can find it on the Best Ever podcast. It's once a week episodes. I'm going to do another 100-episode series. And this is the best of the best, you guys. It's free education. I told Joe, I said, here's what I want to do, Joe. I said, I want to make basically a program for passive investors to teach them the tips, tricks, mindset, philosophy, strategies, formulas. And I want to give that away for free. I don't want to market this to something to sell where you would charge somebody $5,000 to buy this program and learn how to be an LP. I want to do it for free, and I want to do it over time, and I want to do it through your podcast. So that's a great one. I know it's kind of a shameless plug that I'm saying my own podcast, but honestly, it's my passion packed into 5 to 7 minute episodes. And so you can check that out. Passive Investor Tips. There's so many good podcasts out there, you guys. I mean, I could sit here and name you 25, but that's easy to search online. So Best Ever at Large is a great podcast platform.
Awesome. Very good. And then kind of a fun one here and a little more personal. Any personal bucket list items that you've recently checked off your list, and or anything you're planning on checking off in the near future?
Yeah. So this year has been the year of fatherhood. We had our firstborn the December 31st, New Year's Eve. So he's 11 months old. Thank you. And so we sat down and we said, our other passion, my wife and I, is travel, international travel. So we said, when he turns 1, we're going to take him on an international trip. Well, we just couldn't wait. So we took him to Turks and Caicos when he was 7 months old.
Oh,
and that was a ton of fun. So we checked that off the list, but we're planning another trip in the next month or so to take him on another international trip exclusively for his birthday. So for us, that's what we want to instill in him, is different cultures, different values, and just that kind of exposure. Though he probably won't remember it being 1 year old, but we want to do it anyway.
No, that's awesome. And what an amazing story that you're able to share this with your wife and your newborn and really create a life all through passive investing ultimately. So, well, very good. Well, yeah, thank you so much for being on the show. I really appreciate the time that you've spent with us. As I mentioned, you're just an amazing educator and you do just such a great job explaining things. So to our listeners, I definitely encourage you to reach out to Travis. But Travis, thanks so much for being on the show. We really do appreciate it.
Thank you, Randy. Thanks everyone for tuning in.
All right. And to our listeners, as I mentioned, definitely connect with Travis, listen to his podcast, connect with him on social. He provides just a tremendous amount of content. I've learned so much from Travis over the years. He even takes phone calls and schedules times with folks. So I would encourage you to reach out. And again, I would always just say, continue your journey on the education path. Continue to gain the education and the confidence in the space. Because once you make that first passive investment, we are so confident that you'll continue to do so, and it's going to have amazing impacts on your life. So thank you for joining us today. And until our next episode, thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.